A couple sells their house and pays $0 in federal tax on a $500,000 profit. Their neighbor sells a similar house, pockets a similar gain, and writes the IRS a $72,000 check. Same neighborhood, same market. The only difference? The date they closed. Most people assume the IRS treats a home sale profit like a paycheck, taxed at whatever bracket your salary puts you in. That's wrong. Home sale gains are capital gains, taxed under a completely separate rate schedule that tops out at 20%, not 37%. So a teacher earning $60,000 a year, normally in the 22% ordinary income bracket, sells a house and makes a $200,000 profit. Because capital gains rules apply, her maximum federal rate on that profit is 15%. That's $30,000 in tax, not $44,000. The $14,000 difference isn't a loophole she found. It's the default rule for anyone who sells an appreciated asset. The mechanism is the rate schedule itself. But not every home sale gets those lower capital gains rates. There's a cliff, a single calendar day, that separates two very different tax worlds. Hold an asset 365 days or fewer and the IRS calls the gain short-term, taxed at ordinary income rates up to 37%. Hold it more than 365 days, one extra day past that mark, and the gain becomes long-term, taxed at 0%, 15%, or 20%. The cliff isn't gradual. There's no partial credit for holding 300 days instead of 100. It's a binary. Either you're on the long-term side or you're not. Here's how precise that cliff is in practice. An investor buys a house on March 2nd, 2023. She sells on March 2nd, 2024. Exactly 365 days later, that gain is still short-term. She has to wait until March 3rd, 2024, one more day, to cross into long-term territory. Now put real numbers on it. Her gain is $300,000 and she's in the 37% bracket. Sell on March 2nd. She owes up to $111,000 in federal tax. Sell on March 3rd. She owes up to $60,000. That single day is worth $51,000. Nobody negotiating a purchase price would walk away from a $51,000 difference, but sellers do it on closing dates constantly because they never do the math. Long-term rates are already a massive improvement over ordinary income. But for a primary residence, the IRS offers something even more powerful, a rule that can eliminate the tax entirely. It's called the Section 121 exclusion. If you owned your home and lived in it as your primary residence for at least 24 months out of the prior 60 months, the IRS lets you exclude the first $250,000 of gain if you're single, or $500,000 if you're married filing jointly. Not defer it, not discount it, exclude it, as in it never gets taxed at all. The requirement isn't just ownership, you have to have actually lived there. Renting it out or using it as a vacation home doesn't count toward those 24 months. Walk through the math on a real case. A married couple bought a home in 2019 for $400,000 and sell in 2024 for $900,000. Their gain is $500,000. They've owned and lived there for 5 years, so they clear both the ownership and use tests easily. They apply the $500,000 MFJ exclusion. Taxable gain, 0. Federal tax owed, 0. On $500,000 of profit. Now rewind the tape. Same couple, same house, same price, but they sell after only 18 months of living there. The exclusion evaporates. The full $500,000 is taxable. At a 15% long-term rate, that's $75,000 in federal tax. The house didn't change, the market didn't change, the calendar did. So far, we've talked about the sale price as if it were fixed. It's not, at least not from the IRS's perspective. What the IRS actually taxes isn't the profit you feel. It's the profit over your adjusted cost basis. That basis starts at your purchase price, but it grows every time you make a qualifying capital improvement to the property. Add a kitchen extension, that goes into your basis. Paid closing costs when you bought, those go in too. The formula is adjusted basis equals purchase price plus capital improvements plus acquisition costs minus any depreciation you took if you ever rented the property. Your taxable gain is net sale proceeds minus that adjusted basis. And the higher your basis, every dollar counts. Here's how that plays out with real numbers. A homeowner paid $300,000 for her house, spent $40,000 on a kitchen extension, and paid $10,000 in closing costs at purchase. Her adjusted basis is $350,000, not $300,000. She sells for $700,000. Without tracking improvements, she'd report a $400,000 gain. With proper records, her taxable gain is $350,000. She's single, so she applies the $250,000 421 exclusion. After the exclusion, $100,000 taxable versus $150,000 without the improvement records. That $50,000 difference in taxable gain costs her $7,500 in real tax at 15%. The renovation receipts she kept in a folder did that. This is purely about record keeping. Now here's a wrinkle that trips up even careful sellers. Even after you've locked in long-term rates and cleared the 40121 exclusion, the rate you pay on whatever gain remains taxable isn't flat. It depends on your total taxable income for that year. The IRS stacks your capital gain on top of your other income and checks where you land. For 2024, single filers pay 0% on long-term gains if their total taxable income stays under $47,025. From $47,026 up to $518,900, it's 15%. Above $518,900, it's 20%. The gain doesn't set its own bracket. Your whole income picture for that calendar year does. Watch what that stacking does to a real retiree's bill. She has $30,000 in pension income and sells a house generating a $60,000 taxable gain after her per 121 exclusion. Total taxable income, $90,000. The IRS doesn't apply 15% to the whole $60,000 gain. It fills the 0% bracket first. The first $17,025 of her gain brings her income up to the $47,025 ceiling, and that slice is taxed at 0. The remaining $42,175 of gain sits in the 15% zone, so her actual tax is 15% of $42,975, about $6,446, not $9,000, which is what a flat 15% on $60,000 would produce. The bracket filling mechanic saves her $2,554 automatically, and she doesn't have to do anything special to get it. For most sellers, the story ends there. But high earners hit a second layer the IRS doesn't advertise loudly, the net investment income tax, or NIIT. It's a 3.8% surcharge that piles on top of the long-term rate, and it kicks in once your modified adjusted gross income crosses $200,000 for single filers or $250,000 for married filing jointly. The effective federal ceiling on a home sale gain isn't 20%, it's 23.8%. And unlike the income tax brackets, these NIIT thresholds are not currently indexed for inflation, so they've been eroding in real terms every year since 2013. The NIIT calculation has a twist. It applies to the lesser of two amounts, your net investment income or the amount by which your MAGI exceeds the threshold. A single filer with $180,000 in wages sells a house for a $200,000 taxable gain. MAGI of $380,000. The threshold is $200,000, so MAGI excess is $180,000. Her net investment income is $200,000. The lesser of those two is $180,000. So NIIT equals 3.8% times $180,000. That's $6,840 on top of her 20% long-term tax on the full $200,000 gain. The NIIT doesn't just sit on the whole gain. It's capped by how far above the threshold she sits. But at those income levels, that's still a meaningful extra hit that needs to be priced into any closing date decision. Now you have all the pieces, long-term versus short-term, the per 121 exclusion, bracket stacking, the NIIT. Each one is controlled by a different threshold, but they all share the same lever, the date on the closing documents. That's what makes selecting a closing date a genuine tax engineering decision, not a scheduling formality. The sequence a seller should work through looks like this. First, confirm you've held the property more than 365 days to lock in long-term rates. Second, confirm you've met the 24-month residency test in the prior 60 months for the per 121 exclusion. Third, estimate your other income for that calendar year to predict which long-term bracket the gain will land in. Fourth, and only then, pick the closing date that satisfies all three simultaneously. The closing date decision crystallizes in one real story. A couple listed their home in November 2023. An offer came in quickly. Closing in December 2023 puts them at 23 months of residency, 1 month short of the par 121 2-year mark. The full $480,000 gain is taxable. At 15%, that's $72,000 in federal tax. They negotiate with the buyer to push the closing to January 15, 2024. That's month 24. The PORBRA 1 and 21 exclusion clicks into place. They apply the $500,000 MFJ exclusion. Taxable gain, 0. Tax owed, 0. The difference between a $72,000 tax bill and a $0 tax bill came down to 46 days on a calendar, not $1 more or less on the sale price. Every variable in this entire episode, the rate schedule, the exclusion, the bracket stacking, the NIT, converges on a single point of control. Not the listing price, not the neighborhood, not the market timing, the closing date. Price negotiation gets all the attention because it feels like money. But two sellers with identical houses and identical sale prices can walk away with a $72,000 difference in after-tax proceeds, purely because one of them knew which calendar dates mattered and the other didn't. That's the real negotiation. And unlike the sale price, where the buyer pushes back on every dollar, the IRS doesn't negotiate the thresholds. You either cross them or you don't.